Today we got our first major rate cut, not by Jerome Powell, but from the Bank of Canada. And you've seen what happened in markets today. The Russell 2000 up about 1.5%, the Nasdaq up almost 2%, and even the S&P 500 breaking out to a new all-time high, up over 1% today. Nvidia currently has a market cap of $3.01 trillion, passing Apple's market cap of about $3 trillion flat. And a lot of this rally was due to the first major central bank cutting rates for the first time in this cycle. I have news for you. Tomorrow we're expecting another rate cut. Not by the Bank of Canada, not by Jerome Powell, but from the ECB. And this could be even more impactful than Canada. So I will go over what you need to know heading into tomorrow to get your trading day started off right. In the meantime, hit the like button as well as subscribe to the channel if you have not done so already, and only if you find value or perspective out of this video. We will also go over the option activity to end the day in Tesla stock and some news here in after hours that I think you should know. First and foremost, it's worth mentioning today was a good day for a couple different reasons. We did get a lot of data today. We had your ADP employment change, which came in at 152,000 jobs, lower than the 175 estimate, and it does suggest that the BLS report on Friday is going to be on the low side as well. The BLS stands for Bureau of Labor Statistics, and that is your non-farms payroll report. That is the one that the markets really pay attention to. Specifically, there was some weakness in leisure and hospitality, which only added about 12,000 new jobs in the month of May, and that tends to be one of the biggest segments of the BLS report that adds the most jobs. So that directly suggest we're probably going to get a weak jobs number. Now, a weak jobs number, or a weak economy for that matter, has not been seen as good news by markets in the last couple of weeks. In fact, every time we've gotten data that suggests the economy is slowing down or the labor market is weakening, like the JOLTS job openings, which came out 2 days ago, the markets have actually sold off. So I don't think the ADP is what actually caused stocks to rally today. So what really caused today's rally is probably not what a lot of you guys expect. It was one part the ISM services PMI that showed business activity is accelerating in the service sector. At the same time, pricing is actually falling. The two most important components of your ISM services PMI were these. The ISM services business activity that came in at 61.2. Last month you were at 50.9, so that was a big increase from last month. The estimate was 52.3, so that was much better than the estimate as well. ISM services prices were expected to come in at 60. You came in at 58.1, and last month you came in at 59.2. So even though last month you had activity really pick up in the service sector, you actually seen prices fall or not go up as much as expected. That, my friends, is by definition your soft landing. The other part of the rally today was the Bank of Canada lowering rates. They lowered rates by the normal rate cut, 0.25%. Both of these data points today, or at least these ISM services data, we can say definitively, and the Bank of Canada interest rate cut that we've seen today, did have a positive impact on driving down 10-year Treasury. So 10-year Treasury yields were down 6 basis points today for the right reason, for disinflationary pressures, and also because when the Bank of Japan lowers rates to 4.75%, and our bonds are a lot higher with our Fed having the federal funds rate at 5.25%, where would you rather invest your money? If you are a Canadian, okay, Canadian company, citizen, blah, whoever, right? Would you rather take a lower rate or a higher rate? Both countries have the same perceived safety. Canada's, I guess statistically, maybe you would say the US is in better shape because the US is kind of like the gold standard for treasury investing, but not a lot of risk in both countries. What are you going to do? which one are you going to take? You're going to take the bond that gives you more money, that pays you out more. So now US Treasuries look a lot more attractive than they did before. So that did attract more capital today into bond markets, and when investors go out and buy bonds, yields on bonds fall. Now we're also expecting the ECB to cut rates coming tomorrow. Now, this article says here, strong wage growth risks slowing return of inflation at 2%, governing council to lower rates by quarter point on Thursday. Now, the ECB lowering rates is a little bit more important. Now, the ECB's fund rate is at 4.5%. They have not cut rates since 2019 because rates have been at zero all throughout the Rona until they started raising rates around the same time as we did in the US. Why the ECB cutting rates will be more important is because there's a lot more money over in Europe as a collective compared to Canada. So same logic applies as I just mentioned. As the ECB starts to cut rates, and they do tomorrow, that can lead to an influx of capital into our bond markets, which leads to prices of bonds going higher and yields falling, which is normally a good thing for stocks. Now, we will see what happens coming tomorrow, but 10-year Treasury yields have fallen over 32 basis points, and you've barely seen a reaction in stocks. So maybe there's a catch-up rally to be had based on the drop in yields. And I think most importantly, when other central banks start to cut rates, it typically leads to our central bank, Jerome Powell. Now, a lot of Wall Street has started to talk about the Atlanta Fed GDP Now tracker that has basically fallen off of a cliff in the last 2 weeks or so, and this has led to some of the concerns about a potential recession, a sell-off in 10-year Treasury yields, and a large sell-off in small cap stocks also. The Atlanta Fed GDP Now tracker is estimating Q2 GDP at about 1.8%, which is lower than the blue chip consensus on Wall Street. That's about 2.1% for Q2 GDP. Coming tomorrow, we will get exports, imports, and the balance of trade that comes out at 8:30 in the morning, and that will have an impact to the Atlanta Fed GDP. Here you can see the next GDP Now update is Thursday, June 6th. Because of that data. So given the fall that we have seen in your GDP trackers for Q2, tomorrow's exports imports number is normally not that important, but it might be a little extra important tomorrow. And then you are expected to get the ECB cutting rates at 8:15 in the morning Eastern Standard Time. Both the deposit facility rate and the marginal lending rate are expected to fall. The marginal lending rate is expected to go from 4.75% to 4.5%. That's the most time what we talk about when we think about the ECB federal funds rate. And the deposit facility rate is expected to fall as well from 4% to 3.75%. And I do overall think this could get the markets quite excited for our rate cuts coming in the US. Like, it's actually finally happening. Major central banks are starting to cut rates. So if we were going to see a rally based on rate cuts coming, I think it could start now. And so do others. Goldman Sachs sees a wall of money fueling stock market's summer party. that's their note put out today. It says a flood of cash from passive equity allocations will pour into the stock market in early July, setting up a continued rally through the early summer, according to Goldman Sachs trading desk. It says to start off Q2, so the beginning of July, this is when a wall of money comes into the equity market quickly. Goldman's Global Markets Division Managing Director and Tactical Specialist wrote in a note to clients Wednesday, says since 1928, the first 15 days of July have been the best 2-week trading period of the year for equities, and they tend to fade after July 17th, according to Rubner. The S&P 500 index has been positive for 9 straight Julys, posting an average return of 3.7%. The NASDAQ 100 has an even better record, posting gains in 16 straight Julys with an average return of 4.6%. That's insane. So based on historical precedents, June could be good, July could be good. You do tend to get a sell-off before the election during election years, and that's something to be mindful of. But I'll just put it to you just honestly. If it looks like we're going into recession, stocks are going to fall 20+% from here. If it looks like inflation's falling without a collapse in the labor market or economic activity, stocks will do just fine, and rate cuts will be a huge positive. But again, if the Fed's cutting rates because data's coming in bad and things aren't looking too great, that's going to be a bad thing. And I would expect a 20+% rally upon the first Fed cut in that weakening scenario. Bank of America's Savita Subramanian, I'm probably butchering that. In fact, I know for sure I'm butchering that. Apparently, she says sell-side indicators at levels suggesting the SPX, S&P 500, has the potential to advance 13% over the coming 12 months with a 94% positivity rate. And according to a new survey of 116 economists, the Fed is going to cut rates 50 basis points in 2024, according to 68 of them. So that is the general consensus. 28 say 25 basis points, and 5 of them say no cuts. And this comment from Miles says, what did the other 15 say? And as Ryan Dietrich says on X, a 4% or greater monthly gain is fairly rare, but also quite bullish. The S&P 500 is higher a year later, 81.3% of the time, and up 12.2% on average. But that just happened in May, which is actually the most bullish month of them all, higher a year later 10 out of 10 times, and up an average of 20.1%. So again, I will say, it looks like stocks can do well here, and I personally would bet on a broadening out of our markets. I would bet on a Tesla, a PayPal, a SoFi, all of those just random individual companies doing better than maybe the broader indexes. But it all comes down to how the economy is doing. If the economy weakens from here and it looks like recession, no bueno. Not good things are coming out of our markets. And especially if that's why the Fed is cutting rates, that's not going to be good. If the economy holds up and does okay, then that's a good thing. I've said for a long time, at some point, bad news will become bad news, and bad news is now bad news. That time has finally come. Here on the day today, again, you did see a lot of those deep in the money puts that are being bought, specifically around June 21st. Okay, these are not necessarily super bearish trades. They're just trades that hedge funds, institutions want on their long positions, because if things go south with this shareholder vote and the stock falls 20%, they don't want to not be hedged for that event. That's all you're seeing. But when that happens, it creates a lot of shorting pressure again by market makers that almost instantly have to go out and short 100 shares of Tesla stock for each one option that is bought. Here in this trade alone, you had 1,060 of them. So that's 100,000 shares at least that had to go be short by the market makers as soon as that one trade got put on the stock. And that's why Tesla did basically nothing today. But that is also why we are going to rally so aggressive after June 13th, as long as the vote goes through. Instantaneously, you're going to have millions of shares market makers have to go out and buy, probably 10, 15, 20 plus million shares like that, let alone these shorts that decide to cover on their short positions, out of which there's 105 million shares that are currently sold short. So, I mean, you could actually be setting up for a massive short squeeze after June 13th. And that could send Tesla stock well into the 200s. I think a lot of people have forgotten about this, but ever since the judge ruled on the Delaware comp package, that's been a very negative thing weighing on Tesla stock this entire time, whether Elon could up and leave Tesla. I mean, let's just put numbers to this. Elon's comp package was ruled invalid on January 30th, 2024. What happened? Well, you actually sold off for 1, 2, 3, 4, 5 weeks, well, 4 weeks before that ruling. So he sold off a month up until the week of that ruling, just kind of pricing in what happens if it doesn't go through. Tesla stock went from 265 at the high of the second week during that sell-off right here. And then what happened? It was rejected, and Tesla stock sold off over 13.5% that same week and fell to a low of $180 per share. So theoretically, I wouldn't find a problem with Tesla stock going back into the 260s, just like it was before this whole court ruling comp package situation ever started to begin with. I mean, from 265 until now, a lot of this selling, the sell-off we've seen, is because of the comp package not going through and the uncertainty around whether or not Elon's going to stay at Tesla. And that's why I think Tesla stock could rally over 20% on June 13th, as long as the comp package goes through again. And then, as I said, proceed to rally well into the 200s, effectively creating a massive short squeeze. Other news for Tesla and Tesla's competition: General Motors had its best month ever for EV sales in May, with over 9,000 vehicles sold. And let's just be honest, it's not Tesla versus GM versus Ford. It's EVs versus internal combustion engines. Who cares who's doing good? If GM's doing good, that probably means Tesla's doing good as well. Tesla has built their 50 millionth 4680 battery cell at Giga Texas. This comes 7.5 months after Tesla built its 20 millionth cell at Giga Texas in October of 2023. This means that between October of 2023 and June of 2024, Tesla built enough 4680 cells at Giga Texas to make 22,321 Cybertrucks. Each Cybertruck has 1,344 4680 battery cells. Elon Musk's XAI is planning to build the most advanced supercomputer in the US in Memphis, Tennessee. It's expected to be the biggest investment by dollar amount in Memphis history. Senator Bill Hagerty has already went on to congratulate Elon Musk on this exciting new initiative to bring XAI to Tennessee. As far as a technical basis, the charts, Tesla's stock found a lot of support at that 50-day moving average and a lot of resistance today at the 20-day moving average. We were holding the 20-day moving average as support for, this was May 30th, May 31st, and June 3rd. Now you have fallen under that, and now you're holding the 50-day moving average as support, and your 20-day moving average has acted as resistance yesterday and today. And again, I expect we're going to trade between the 50 and the 100-day moving average before June 13th. The large gains, or the large fall, God forbid, in Tesla stock comes after June 13th. But I will say, the more the markets rally between now and June 13th, let's say stocks continue to rally from here, that's going to be more of a catch-up rally potentially that Tesla will see. You also did have a couple earnings today in after hours. You had Five Below, they're down 15%. Lululemon is up 10%, and you did have Victoria's Secret that really didn't move much at all. They went up and then went down, only down about 1%. So the consumer's still a bit of a mixed bag. With that said, let me know what you think about all of this information down below in the comment section. Are you bullish? Are you bearish? What do you think about all of this? Do you think a potential short squeeze is coming after June 13th? Let me know down below in the comment section. Thank you for watching. Hit the like button and subscribe to the channel if you have not done so already. If you guys do want to come trade with us live in real time, get access to all of the trades that I make, winning or losing, each and every single day. Down below in the description of this video, you will find a link for just that. You guys enjoy the rest of your day and night, and I will see you in the next one.